All right, welcome to The Explainer. Today we are cracking open Swisscom's Q2 2025 earnings report, and let me tell you, it was a real head-scratcher. Just a ton of conflicting signals sent out to the market. So let's dive in and try to figure out what's really going on. So here's how we're going to break it all down. First, we'll look at those confusing headline numbers. Then we'll dig into the two main battlegrounds for the company, their home turf in Switzerland and, of course, the big new project in Italy. After that, we'll check out what management is forecasting, and we'll wrap it all up with our take on what to watch for next.
Okay, first things first, let's get right into the numbers that flashed across the screen and see why everyone was, well, scratching their heads. And boom, right here, this is the central puzzle of the whole quarter. On the one hand, you've got operational profit. And to add another layer to this confusing picture, the top-line revenue also came in a little light. Not a huge miss, but still 1.2% below what analysts were looking for. And you remember that big earnings per share miss we just talked about? Well, this is what's driving it. Net income fell a whopping 22% short of what everyone was expecting.
So you've got a beat on one hand, a miss on the other. What did the market do? Well, it basically just shrugged with a bit of a frown. The stock ended the day down about 0.5% on more volume than usual. So no panic selling, but definitely not a standing ovation either. You can just feel the market trying to figure out, okay, which of these numbers is the real story here? Okay, to really understand what's going on here, you kind of have to think of Swisscom as fighting on two totally different fronts. And we're going to start with their home base, the fortress, right there in Switzerland. So the business in Switzerland, it's just a rock, solid as a fortress. Their brand is the strongest in the country, they're hitting their cost-saving targets, and they just keep pouring money into their 5G and fiber networks. They've even rolled out this new cybersecurity service called beem for businesses, and it's getting some good early buzz. You know, this is the predictable, cash-generating engine of the whole company. And it sounds like things are getting a little easier on the home front, too. The CEO, Christoph Aeschlimann, basically said the market's calmed down. He noted that their big rival Sunrise is being a bit more rational, which is code for not starting crazy price wars. That's good news, although he did say the other competitor, Salt, is still pretty aggressive. But, you know, even the strongest fortress has its vulnerabilities. And for Swisscom, that's a slowdown in IT spending from their business customers. With the economy being what it is, a lot of companies are hitting the pause button on big tech investments, and that's definitely creating a headwind for growth in a really key part of their business. All right, so that was front number one. Now for front number two, the Italian job. This is the big one, the massive, super complex, and absolutely critical integration of Vodafone Italia. Honestly, this single deal is defining Swisscom's entire year, and it's where all that confusing noise in the financials is coming from. Yeah, this isn't a simple flip of a switch. It's a huge multi-stage operation. As you can see from the timeline, they've got the organizational stuff sorted out, but the real payoff, the cost savings, the synergies, that's not really going to kick in until later this year and especially into 2026. So this is very much a please be patient, work in progress kind of story. And a huge piece of this puzzle is a complete 180 on strategy for the Italian mobile business. See, the old way was all about volume, chasing new customers, slashing prices to get them in the door, which, surprise, surprise, led to a ton of customers leaving, high churn.
The new strategy, it's all about value. Forget the price wars. The focus now is on keeping the customers you have and increasing how much they spend over time.
And get this, we're already seeing proof that it's working. Just look at this chart. Customer churn, the rate of people leaving, has dropped like a rock in just 1 quarter, from almost 24% down to 18%. That is a massive operational win and a really, really good sign for the future of that business. There's another bright spot in Italy too, and that's their wholesale business. This is where they sell network access to other companies. And that part of the business is absolutely on fire, growing 31%. It's providing a really nice stable stream of revenue while they're overhauling the main consumer side of things. Okay, so we have the stable fortress in Switzerland and the massive construction project in Italy. Given all that, what is management actually telling us to expect for the rest of the year?
Well, they're sticking to their guns on the big targets for profit and spending. But, and this is a big but, they put in a major warning label on revenue. They're now saying to expect sales to come in at the low end of their forecast, or maybe even a little bit below it. That, right there, is a pretty clear signal that they're feeling cautious. And it's not hard to see why they're being cautious. They're getting hit by a few things all at once. We already mentioned that slowdown in business demand. On top of that, the Swiss franc is super strong right now, which actually hurts the value of the money they make in Italy. And of course, costs for everything from energy to people are still going up. Okay, so remember that big puzzle from the beginning? The operational beat and the huge earnings miss? Well, here's the solution. That crazy headline-grabbing 22% miss, it had nothing to do with the day-to-day business. It was all accounting, specifically non-cash charges that come with buying a massive company like Vodafone, things like amortization and extra interest. It's what I'd call acquisition noise. It looks bad on paper, but it's not a sign that the actual business is falling apart. All right, let's bring it all home. What should we be watching for in the next call? And what's our final rating on the stock after this quarter?
For the rest of the year, it really boils down to 3 key things you need to watch. Number 1, the Vodafone integration. Are they actually delivering on those cost savings they promised? Number 2, the business-to-business pipeline. Can new stuff like Beam make up for the slower economy? And number 3, all that outside stuff. Are things like the strong currency and roaming price cuts going to get better or worse? So where do we land? Our rating is market perform. It's really a story of 2 halves. You've got the stable, reliable Swiss business, which is great, but that's perfectly balanced out by the huge risks that come with pulling off this Italian integration, not to mention all those economic headwinds that don't seem to be going anywhere fast. And that really leaves us with the one big question for Swisscom's entire strategy. Are they trading a whole lot of short-term pain right now? You know, the messy results, the integration headaches, the cautious outlook, for a massive long-term gain in Italy? Is it worth it? We'll have to wait and see. The next few quarters are going to be absolutely crucial. And remember, this is not financial advice.